This is Michael Schulman again, and I know something about dead companies and dying stocks. I know they are easy to spot, but if you own them, very hard to sell. It's that old, reliable company that has been around forever and seems to have been in your portfolio for just as long. It's the hot stock you rode all the way up for amazing profits and then held on to and experienced devastating losses. Or it's a stock you own that is still the darling of the financial media, and everyone is predicting that big comeback. You can't let go. I understand. Let me help you. I just finished this report, Dead Men Walking Stocks, 25 Zombie Stocks to Sell. Right now, I want to share with you a story about 5 of those stocks that will help you realize why you have to let go of these dead or dying stocks. If you own any one of the following, in my view, these are the names to move out of to generate cash or prevent getting killed in the long term. And if you don't own any of these, please avoid them. Let me step back for a minute. The financial world has changed dramatically in the past 5 years. If you are like most investors, preserving your capital is your number one priority. You cannot afford to lose money. You may not realize it, but you continue to invest the old normal way, and that is a formula, quite often, for losing money. That old normal way of looking at things pushes you into hot trends that actually have already burnt out, or into the arms of pundits on television talking their own book of business. The old normal creates potential disasters for your portfolio every day. The disaster can be a bubble stock, like First Solar. The disaster can be a value trap, like Research in Motion. That disaster can unfold in slow motion, a stock that is dead money now and forever a slow motion train wreck, like Dell. That disaster can be a high dividend stock, to some, that will be forced to cut dividends due to an unbelievably disastrous change in their business, like Pfizer. And that disaster can be counting on the economy to do something it cannot, for consumers to behave like they used to behave, and they will not. And the disaster would be holding on to a stock like Walmart as the company stays stuck in the mud. Let's take a look at a recent classic bubble stock. I recently had lunch with one of the smartest and most successful individual investors and traders I know. He shocked me by saying he was looking at renewable energy stocks. I laughed and asked him, where and when did you lose your mind? And felt as if I were talking to a Wall Street analyst. They get paid to lose their minds. Why did I say this? Because renewable energy is not a self-sustaining mass market industry. It is supported by huge government subsidies that are going, almost gone, due to austerity already in place or coming in every developed nation in the world. Add to that a newfound love in North America of drill baby drill and frack baby frack, and the end game for renewables is here, an ugly end game of niche products for niche needs in niche climates. The big name in renewables is First Solar. It was down 23% in one day just a few weeks ago. Their time has come and gone. They are down big time. They will get hit even more next year and the year after that. Take your money and go find an outfit that makes drilling equipment, maybe Baker Hughes. First Solar is a dead company. Survive? Yes. Grow? No. Am I pro-oil over alternative energy? Not at all. But I'm not going to fall in love with beliefs. I'm going to fall in love with reality. And I don't fall in love with companies or stocks where there is no sustainable market. Then there are once favorite high flyers that are dying. I just ate lunch. Sushi makes me think better. It's real brain food. And I was eavesdropping on the guys at the table next to me, as I always do. One said to the other, I heard Research in Motion was struggling. His companion responded, good. Now they'll let us get iPhones. Pretty much says it all. Research in Motion, the company, is not dead yet. RIM, the stock, is dead, and it's beginning to decay. Why? Think Apple, and think of who loses when the iPhone and the iPad succeed. Think of who loses when Android phones succeed. RIM is losing market share to both the iPhone and to Android phones every day, every week, every month. The company tried to compete against the iPad and just took a $500 million write-off on its terrible failed entry into the tablet market. People in corporate America, their core clients, are giving up BlackBerries for iPhones and Androids. Management is behaving as if there's Valium in the office water cooler. And analysts with little real knowledge of the marketplace are screaming, they gotta come back. There's value there. No way. The war is over. They cannot overcome Apple's first mover advantage and Google's strong follow-up. Sell RIM if you own it and avoid it if you don't. Speaking of seeming value traps, what about Dell? Huge market share still in computers, especially in corporate markets. A great brand. Excellent presence in Asia. So what? Big deal. You either grow in the computing business or you begin the ride to the stock cemetery. Dell is taking that ride as we speak. IBM is long gone from the PC business. HP decided to do it, fired their CEO, changed their mind, said they will stick with PCs, but in a few more quarters they will change their mind again and be out of the personal computer business. IBM and HP have huge enterprise businesses barely touched by the profits from personal computers. Dell, on the other hand, has nowhere to run and nowhere to hide. For them, it's all about the personal computer market and servers. The company has no tablet. The company has no smartphone. And these are the markets where real growth is happening. And its core business of selling computers to business is stagnant and will shrink on a revenue basis as more companies move to the cloud and require only bare bones desktop and laptop computers. And recently, market researcher the Gartner Group cut its worldwide growth forecast for personal computer sales in 2012 to 5% from 10%. Not a good thing for Dell. Dell was a growth stock. It is now a commodity supplier of a cheap business appliance with lousy profit margins. No growth for the company, no growth for the stock. Please, stay far, far away. How do you lose half your sales of your most important product in 30 days and keep investors happy? You boost your dividend and share buybacks while you can. Just do not tell anyone you really cannot sustain this financial suicide for too long. For 5 more months, actually. That is Pfizer's story. Generic Lipitor hit the market, and less than 1 month later, the company lost 50%, 50%, 5 and 0, no dot in between, of its share of Lipitor prescriptions. The financial impact is muted as there is only one generic allowed for the first 6 months after a patent expires, and prices typically hold up. What happens after 6 months? A host of generics enter the market. A radical drop happens in pricing, and that inevitable slide to cutting its dividend is on the way. Once the dividend is cut, the stock will get crushed. You simply can't change the math. What is Wall Street's view? Pfizer will figure it out. Same thing they said about Lehman Brothers and the New York Mets. Sorry, you just do not figure out how to save an $11 billion revenue stream. That's billion with a B. The revenue stream will take a massive hit after May of 2012 as generics enter the market in volume. And with that go profits and eventually the dividend and the stock. I know that Pfizer is one of the most widely held stocks in the US and around the world. But if you own it, you probably have realized that it has been dead money for some time, and this patent expiration certainly isn't going to help. Sell it or avoid it. Retailers are all about consumer spending, and the key to spending is not the unemployment data or a seasonal surge in travel or auto sales or gift giving. It is the amount of disposable income people have to spend, and it is a lot less than it was 3 years ago, and that is very bad news for Walmart. Whoa, Schulman, whoa. Walmart's a deep discounter. It thrives when times are bad. Those are the emails I get. Sorry, that's a rerun from the last recession. This recession is much worse, and people no longer have the cash or the credit to load up once a month at Walmart. Instead, they shop week by week, perhaps day by day, at the dollar stores. Dollar stores that are now new, that are now well lighted, with groceries and other necessities. And how is Walmart responding to this loss of market share to the dollar stores? They're opening 50 small footprint stores through the course of 2012. The dollar store industry is opening 2,000 500 new stores. Walmart is bringing a knife to a gunfight. It's a done deal. Ignore the pundits who scream louder than those frustrated Met fans. If you own Walmart, sell. If you don't, stay away. It is best to be neither a bull or a bear. Be a contrarian. And when it comes to stocks to sell or avoid in your portfolio, listen to a contrarian. Let me help you make those tough decisions to part with that old friend of a stock hurting your portfolio. And always do what I do. Check out the storyline, check out the math, and avoid those value traps and old names from the old normal. Get started with me here, but move on to all of the 25 dead or dying stocks in the report, Dead Men Walking. They are the first casualties in an era many are calling the new normal. Thanks for listening. This is Michael Schulman.